And welcome everyone. Thanks for joining us on Finance at JCL. We've got a new series today and it's called Voices of Finance. And I'm absolutely delighted to be joined by Emily for the first episode. So perhaps Emily, I just hand straight over to you. You could perhaps give a quick introduction to the audience.
Yeah, of course. So I'm Emily Fleur and I'm a photographer. And I've always been really interested in business and finance. And people have always viewed that as I want to make lots of money, but it's more I'm just quite genuinely interested in how it all works and how the world how everything pans out. And I've always just loved starting businesses and seeing how I'm really interested in how the finance of the world keeps the economy turning and different ways you can make money and how you can. And that's why I got really interested in stocks and shares. Part of my business is marketing, and with that deal with a lot of different businesses, and I actually feel like stocks and shares is quite a good thing to have the knowledge of, just so you know how the economy is doing. But yeah,
Cool,
about
lovely.
me.
Thank you.
I'm interested.
I'll do a quick plug for you because you've got your website emilyfleur.com. So if people want to find out more around what you do on the photography and marketing side, they can head over to there. But let's crack on. So I've devised an icebreaker for us just to get into the flow of the conversation. It'll be relatively informal, so don't take it too seriously, right? So the first question, got quick fire: beach or couch?
Couch.
YouTube or podcast?
YouTube.
Mortgage or rent?
Mortgage.
And then Apple or Samsung?
Apple.
You're doing so well to that last one. Excellent. Right. So we'll have a finance question into that. So what's the first stock that you ever bought? Let's get into the sort of the finance side now.
The first stock I ever bought. So I got into stocks and shares when we went into lockdown, because all my work stopped. I was at home and I was like, this is a really great time to and everyone was talking about the stock market and how it crashed, and that made me really interested. I wanted to see what that meant. I didn't you know what it means, but you also don't. So I put £2 on Boohoo because Boohoo absolutely crashed, and then it actually exploded because everyone was then going online for their clothes shopping. So I only put £2 on because I knew nothing. So I wanted to just test the waters. But yeah, £2 on Boohoo was my first one.
Inadvertently, you've actually hit on several of the key points of investing that a lot of the books talk about, which is, well, firstly, they say don't buy something unless you understand it. So you've only got in, like, say, minimal amount because you recognise that you're new to it. So I think that's a really good thing. And there's certainly a school of thought that says when you're starting, you've got to start, just get involved, and also learn from books and other people. But learning for yourself is always perhaps the easiest learning, the learning that goes to heart the most. So you've taken the sensible step, not just gone all in, just dabbled just to see. And then you talked about macro conditions, and some investors do invest on that basis. So you've looked ahead, right, this business could benefit from headwinds in the economy because everyone's at home, and you then taken that action. So that's really cool. So maybe perhaps without explicitly knowing at the time, your brain was already ticking around.
Yeah, I was trying to be quite clever with it, but obviously no one actually knew what the pandemic was going to do. But I was trying to there were certain ones I bought that I was like, I think this might do well, or this has crashed and it will come back. But obviously no one actually had a clue.
Yeah, the other thing, actually, you're probably a bit cleverer than me and Boohoo there, because if you look at my portfolio at the moment, Boohoo's probably one of my biggest losers at the moment. So if I'd done what you did and put the same amount of money in then, I'd be up, or at least not down as much. So there's a lesson. Everyone can learn from each other, right? That's the thing.
Oh, 100%. Yeah, definitely.
So you sort of dabbled in Boohoo as your first stock. So just a bit wider, what's your sort of general interest in sort of investing or personal finance?
So it's a good question, and I think my interest is I quite like looking at how it affects things. So there'll be a news report go out, and you'll just see the stock market absolutely like go one way or the other. And I think that's super interesting, and I think it's really good for us to have a knowledge of how different world affairs affect everything. You can see from being involved in stocks and shares what the rest of the year is going to look like. Are we personally going to be struggling in some aspect? With farming at the moment, it's been a really tough year, and I know the knock-on effect is that all our food prices are going to go up, and you can see that on the stocks and shares. And I think it's really good to have a knowledge, even if it's only a vague knowledge, just for yourself. And then I get really excited about how to make money. Like I genuinely get like I'm probably a bit too into working out different ways. And again, I think it's not to necessarily be a millionaire or anything. It's just I find it very exciting when I work out a way that you can make £10 here or there. And I'm like, why has no one else worked this out? I always think I've come up with a genius idea. I'll run downstairs to my boyfriend. I'm like, oh my word, this is a great idea. And he's like, what about this? And I'm like, good point. That's why no one else does it. But I'm very much a person that I go with my gut, whether that's good or bad. I go with it. If I think something's a good idea, I will do it. And because I just love, for me, it's not necessarily the end goal. It's just being involved in it, and like the excitement you get from your stock going up £2 and being like, yeah, I did that right. Or like, I learned so much. Sorry, and I know you're probably gonna ask me about this later on and we'll get into it, but I had a stock get to like 700% or something.
Which one was that?
It was a cannabis company.
Oh, yeah.
It's because Canada legalized cannabis. It went through the roof, and I got so excited about watching it go up. I didn't sell it because I thought it was so fun to watch it go up. And now it's in like -%. And
You've actually interestingly hit on probably what I think, for me at least, and I know a lot of other people said this, but what's the hardest skill in investing in the stock market? Arguably, it's when to sell.
100%.
Because everyone says, oh, buy low, sell high, and that's easy to say on paper or in hindsight.
So easy to
Got
say.
in your portfolio something that says plus 700%. You're like, well, I quite like that there, particularly if you can show it to other people.
100%.
And I know I've kind of fallen foul of that on one or two where I've kept it in my portfolio, because you do a portfolio of sharing on my channel, and then it looks good to have a high percentage. But actually, the objective isn't to make money on a particular stock. It's overall grow your portfolio in actual pounds terms, or whatever your currency is. That's the thing that matters the most. So if you have your 700%, yeah, well, when do you sell? Because actually, there could have been no information that suggested it was going to crash. That's
yeah.
So
And
it's so tough to know when to sell.
And I guess that was just greed coming into me, because I was just like, oh, it might get to 800, might get to 900. Like, I just, to this day, I'm like, why didn't I sell? But it wouldn't have made me, because I only put in a small amount of money for each one. It wouldn't have made me millions or anything. But then there's always that aspect, isn't there, where you're like, if I had put more money into that, I would have this. But that's the way it is, isn't it? You can't beat yourself up over things you didn't do, because how are you going to know?
So I think there's two key things you've picked on there. One is conviction. And if you're absolutely convicted this stock is going to do really well because the underlying business is going to improve or it's massively undervalued, then should you go more into those? Because then your reward when it comes through, hopefully, is then material to your account. So that's one thing. Yeah, it is a tricky one. It's definitely a tricky one to sell, though.
Is there something that you do that you, or is there something you like? For me, how do I know when to sell? What would you do in that situation?
Yeah, it's a fair question. So I would probably try and go backwards a few steps. And I've only learnt this relatively recently, just sort of managing my own portfolio, which is right, what's the overall objective? What are you trying to do? And whether that is protect your money or whether that's take an income or grow your portfolio a certain amount. It could be many things for many people. It's almost like write that down and then use that, first of all, as the lens by which you view your decisions. So when you buy or sell, go to that objective and say, right, does this transaction align with this objective? So if you're buying a cannabis company to start with, does it make me X amount per year, for example? And on the selling, you're just looking at the company then to say, has something intrinsically changed with the company? So are they much better or much worse? So therefore, could it keep going up, or might it drop off? And then it's almost like, do you have any better ideas? There's so many different ways, but yeah, do you have any better ideas? So if you've got another idea, you found something that's really cheap, do you then just say, actually, I've got this one that shot up so quickly that why would it go up more than 700% in a short period of time? That's quite an outstanding amount. Do you then flip it out into, take your profit or table and flip it out into something maybe that pays a 5% dividend, or that's something that's really undervalued? And I think the answer to that really depends on why you bought the company in the first place, what your portfolio objective is. But also there's a book called One Up on Wall Street from Peter Lynch, which I recommend to anyone watching or listening. And it's got there are 6 kinds of stocks, and depending on which of those 6 types it is, will determine whether or not you buy or sell. So if you've got a fast grower, if it's still growing fast, then you might treat it one way. If you've got a cyclical company, like an oil company, where the oil price is high, the share price goes up, the oil price is low,
Yeah.
share price is low. So maybe you're at the higher end of that commodity cycle. Perhaps you sell that for that reason. So I've answered your question in about 4 different ways there. That's the thing.
And how do you know? How do you know about? So I am rubbish at knowing about companies.
Mm-hmm.
You were like, is it the kind of company that is failing in one aspect, or how do you know? Do you like Google it, or?
Yeah, there's a few ways. I think one of the things I haven't done well, let's start off with a negative, is I've got too many companies in my portfolio, so it is harder to keep track of that aspect on all of them compared to if I had, let's say, 10.
Yeah.
With 10, you might have 5 or 10% of your money in each. And then if you're not convinced yet that you're good enough to put that much money in each of them, if you get it wrong, you're going to lose a lot more. So there's that aspect. But what I do is I've got a platform called ShareSite, which tracks the kind of compound annual return, capital, dividend, and currency in all of my holdings.
Oh, okay.
I can see how each of them is performing, not just on a total basis, because most platforms you go in, it says how much your price has gone up by, but it won't include dividends, and it won't do it on an annualized basis. So I'll go into ShareSite to see that. But on that website, they've actually got a sort of a subscreen under each position that's like news. So any news from major sites it's aggregated.
Oh, that's cool.
So I can go in and look at particular stocks on a periodic basis just to see what the news is, as well as understanding its performance. So you can look at performance too much sometimes. If you're looking at it like every day or every week, you're going to make yourself nuts, because if the market goes down for a few days, your portfolio will lose an amount and you'll start questioning yourself, but it's just a normal movement. So over analysis is a problem. But yeah, that aggregating service, I also look at when I'm looking at the companies when their earnings come out, then Yahoo will generally have quite a lot of links to news,
Yeah.
and then YouTube as well, where certain people have certain positions, and then they'll post reviews of it, and then that
Okay.
links into ourselves, because when I post review, then I have to do the research in a bit more depth before I post it.
Yeah. Yeah, because this has always been my issue, because I go with my gut. If I think something's a good idea, I just do it and I don't do any research. And I just go on what I think will work, which is obviously a really bad way of doing stocks and shares.
Not necessarily. I think that there's plenty of ways to skin a cat, as they say, right? So you perhaps are a bit more of maybe a macro investor, just thinking out loud here, whereby you're thinking perhaps like people are locked down at home, as was the case. Therefore, certain companies, Zoom, Amazon,
Yeah.
Boohoo, online risk, they'll benefit, and then you buy into
Yeah.
the ones where you know the name. So perhaps you're buying the
Yeah.
market leader. It's
Yeah.
good to buy a market leader, right? Because they're least likely to fail. They've got
Yeah.
the advantage. And there's definitely something to that. It's one way to invest. I don't know whether it's the best way or not. But if it works, it's definitely a proper way of investing, right? There's the other way, of course, is you can say, well, if you don't research companies, you might buy ETFs or funds for certain industries. So you might say, well, banks are going to do well in period X.
Yeah.
And therefore, you just buy a banking ETF or fund that has loads of banks within it, so you don't need to worry about the research, because you just buy all the banks.
Yeah.
If they are all going to go up, then you're in business. So that's possibly a way to do it. And of course, you could do the index as well, but then that's maybe less of a gut feel, because that's just you're averaging every month, and then at the end of time, you get a nice payout, hopefully. So I wouldn't necessarily worry, do yourself down, particularly if you're on a starter portfolio with small amounts, for doing the gut feel thing. It depends what you want to do going forward. And I should perhaps do the disclaimer for everyone listening. This is just our personal opinions, right? It's not financial advice or recommendations.
Oh, yeah. Do not follow my financial advice. I just have a great time with it and see what happens.
Well, then that's great. If you've got an enthusiasm to actually look at it and be interested in it over a period of time, I think that's part of it. Because if you don't have that, then maybe you shouldn't be picking stocks, right? But I would say if you have an objective, whatever that may be, and just sort of, it doesn't have to be particularly spectacular, like 20% a year, because that's very, very almost impossible to get over a long period of time. But if it was 5% a year or 7% or somewhere in that sort of region, you could write that down and then think, right, how am I going to do this? And then your gut might sort of lead you to looking at certain stocks. You might think, oh, do you know what? Really bad harvest this year, or food shortages, probably not going to buy stocks in a certain sector, but I might do in other sectors that benefit from that, for instance. So that might lead you to a group of companies, then you can maybe have a look to see who the leader is. So that's possibly one way of doing it. But I think with your portfolio being, from what you said, relatively spread with small positions, you don't need to do that research per se. But as soon as you start putting decent amounts in, or you start going for that objective, you then need to start thinking about perhaps being a bit more selective, larger amounts, and that's probably when you would need to do that research, because you can't get away with it.
No.
Over a long period of time, unless you buy Berkshire Hathaway and the index, or Microsoft. But even then, the valuations might be expensive.
So I use Trading 212. What do you use?
I've got four or five, I think. So I've got Hargreaves Lansdown, which was my original platform from many
And
years
what did you
ago.
first buy when you
Compass Group was my first.
okay, I've got them too.
I did really well over that. They absolutely crashed in the pandemic because of the catering.
So that's when I bought them, was in the pandemic.
Good time to buy. To buy. I had quite a good dividend off them over several years. They went up a bit after a while. Then I sold out of them because I wanted to put money into something else. Obviously, it went up again a bit more, so I didn't pick the top. But then you can't beat yourself up over that, because you never know the top or the bottom, right? But I made it a decent amount. It was at least 50%.
Nice.
I need to remember the exact figures to look at ShareSite. But yeah, definitely made money from it over a period of time. But it could have been high. At the peak, obviously pre-COVID, I think it was at 150%, including dividends.
Nice.
If memory serves correctly.
So what are the other three that you've got? As in,
just to complete your question, Hargreaves Lansdown, that was the first one because it's very good for funds. So if you're looking at index funds or managed funds, they've got a very, very wide selection there.
okay.
And quite a good stock selection as well. So I started with them, but the stock trades individually have got quite a big fee attached to them.
And I was going to say, do they take, when you take money out, do they take a big fee? Like, how does that work?
No money just gets sent to your account. There's no charges for anything. It's dead easy. I've done it a few times with them, and yeah. How
do they make their money? Sorry, I've got so many questions.
So they have a trading fee. They have a platform fee, which is capped, but it basically is like 0 point something % of your portfolio capped at like 100 quid a year or something on those lines. I need to check out the exact threshold.
Okay, yeah.
And then when you do a transaction with a foreign stock, they'll charge a foreign exchange fee, for example.
Okay.
That's probably where most of it is. I've got Interactive Brokers, and I join them because their transaction fee for American stocks is $1 or even less sometimes. And the range of stocks on that platform is absolutely like insanely large. There's so many, you can get pretty much anything on there. So companies you can't find on normal platforms, they're on that platform.
Yeah.
So that's where I went with them. Who else am I on? I've got Freetrade. No transaction fees, but there's a more limited sort of selection of stocks unless you pay to open up a wider universe.
Okay.
So that, lower fees, lower foreign exchange fees, but then if you want like an ISA or the wider universe, you pay a monthly fee. And I've just started to look at Invest Engine.
Okay.
Which is like an ETF platform. So I'm going to do a video on that soon, which is like how to register, how to start with Invest Engine. So keep an eye out for that if you're interested. But they seem to be specialised in ETFs, so the exchange traded funds.
Okay.
That's my answer to the short question.
Yeah, no, it's brilliant because I feel a lot of people like the idea of getting into stocks and shares, but they just I think in your mind you have to have like a broker in Wall Street, and like it's all that kind of. I think that's what people think in their minds. So it's like, how on earth do you get involved in it? Whereas actually there's a lot of different ways to do it, right? Like I find it very simple on my app on my phone to just play around with it.
This is the thing now, compared to 10 years ago, you can literally just tap it and you've done a transaction in 20 seconds. Opportunity, but also a problem because you can then be like, oh, just that a bit of that one, and you can over trade, or it's almost too easy to do it, and then maybe you do stuff you shouldn't do. Generally speaking, not you specifically.
Yeah, no. But no, I do think it's quite interesting how people probably don't realize it's so easy to get into. But obviously, that does have its downsides. I have to be very sensible because I'm aware I don't know what I'm talking about.
Well, I'll tell you what I'd suggest for viewers or listeners.
Definitely.
That's it. Just holding up a book, Richest Man in Babylon. I actually did a review of that the other day.
Oh, okay.
That always sets you up first of all. So if you see all my little tabs.
I was just looking.
I've made on it, which interesting bits. But it sets up that personal finance bit first, because I reckon you shouldn't start investing until you actually sorted your personal finance side out. So maybe that's high interest debts, or maybe you haven't got a budget where you actually pay yourself first, allocate a percentage of your earnings to savings, ring fence. Always do, and then whatever's left is for your expenditures, your entertainment, etc.
Yeah.
And once you've got that, then with that ring fence monthly money, or however you do it, what do I want to achieve? And be really clear about what you want to achieve. Then once you work out what you want to achieve, then you can say, right, what's the best way to do that? Is it index funds, ETFs, stocks? Or what do I want to learn about? What have I got the time to do? Then once you work that out, then you can pick your platform that we just talked about. Once you work that out, then you can actually start. So you could just like start and go. There's nothing wrong with that. If you're being like, once you're starting with proper amounts of money, you've had a bit of a play around, you've worked out what it's all about, you need to, in my view, have all those steps in place to give yourself almost what you call the conditions for success. So don't just go with the flow. If you've got a bit of a plan, even if it's high level, your brain kind of, with people with plans, like the brain starts focusing, right? And you're thinking about it in those terms.
No, definitely. I think it's really interesting. My mindset's always been only invest how much you're happy to lose.
Absolutely.
Like that was like only invest what you can. So I put in £100. I think I put in £100 into Trading 212 when I first started. Sorry, you just cut out. Looks all fine. Yeah, I put £100 into Trading 212 because I was like, if I lose £100, it doesn't affect my life. So I've always just put in how much money won't affect my life if I lose it. Like, can I still do everything? Can I still pay for everything? I've obviously got a lot of costs with the business. I employ people. I need to always make sure I'm only putting in something I can lose, which not everyone can do, because if they're actually wanting to do it if you're going about it to make an income, obviously you have to be more risky than that. But I've slowly built it up, and obviously I've got more than £100 in it now. But that was my mindset to start off with. I was like, how much can I live without? But it was in the pandemic, and I was a wedding photographer, so obviously I didn't actually know what finance situation was going to be, so I didn't put in much. But yeah, I think it's really interesting how people go about what they put in, especially at the beginning. You're like, I don't know what I'm doing.
But I think, again, you've hit on one of the key points there. Almost treat it as a separate account. So if you've got your main money and day-to-day stuff, but if you invest stuff, you have it over here and pretend it's like a different person's money almost. Definitely. And then it never interacts with your main stuff unless you're putting money into it, and assume you can never touch it.
Yeah.
And this is effectively what you've done. You said, if that all goes, it's not going to impact my day-to-day or business operations. So you effectively ring-fenced as a separate thing entirely, which I think is perfect. That's the right thing to do, because then you're in that mindset, right? I've got the separate pot of money I need to manage. It's not going to. I'm not going to have to worry about that pressure. If I don't make 10% a year, then I don't have enough income to pay the other stuff. So you haven't got that. So then perhaps if you're getting close to retirement, then you need to start thinking about how it interacts back the other way.
Yeah.
So you're quite a long way from that. So
hopefully. Yeah. Is there anything that you would? Sorry, I think my internet is hating life a little bit. What would be like your first go-to? If I came to you and was like, I love the idea of stocks and shares, what would you say go to a set? Is there one platform in particular that you'd say to go to?
I think it depends on what you're trying to do. So if you're doing, if you just wanted to do something long term, not spend any time on it, I'd say index trackers through Hargreaves Lansdown probably.
Okay.
If you wanted to get really active and say, I want to be shares here, shares there, spend loads of time, I might say Interactive Brokers. And then if you want ETFs, I guess in the middle to an extent, I'd say Invest Engine.
And how are you supposed to know what? Because when I opened my account, it was like, do you want is it CFDs?
Oh yeah.
There's all sorts of different. How are you supposed to? Is it EFT? What do you go to?
Yeah, I mean, I don't understand CFDs, so I don't.
Okay, great. Because
comment on them.
When I opened the account, it was like you needed to choose which one you wanted to.
Yeah.
And I was like, oh my God, already out of my depth.
Well, I think that's the thing. Again, if there's a bit you don't understand, don't do it, because a lot of these platforms like Trading 212, I think plus 500, even Interactive Brokers, you can do options, you could do CFD, you could do all sorts of other things that aren't just buying stocks and shares to put in an account, an ISA or a pension. So I'd certainly stick to your core bits about what you're there for. And I would certainly suggest not going into those more complex things unless you've done research or
of
training, etc. Because I don't understand them, so I just don't look at them. And that's the way I think people should think about it. If you don't understand it, don't go near it.
Don't touch it. Brilliant.
So I've got another question for you.
Mm-hmm.
What finance or investing books have you read?
I can't think of one finance or investing book I have read. Not one that I definitely would have started some. 100% would have started them, but I lose interest very quickly on anything that's not. I have never picked up a finance or investing book that I was like caught my, like when you can't put a book down because it's so interesting. I haven't found a book that does that for me because of how I am. I'm just like, I can't just sit and read unless it's really engaging. Like we're very different on that. Like you're very intellectual and like
Thank you.
like that side of things, whereas I'm like, I have to be hands-on doing it to is there a book in particular that you'd recommend to someone like me that would find it overwhelming to read something?
I'll go for two, depending on what stage you're at. So if you're brand new to all of this stuff, so I'll plug the Richest Man in Babylon. It's literally 200 pages, and if you look at the the size of the
doesn't look scary.
Really easy read. A few hours you can smash through it. Most of the good stuff, probably the first 2/3 of the book as well. So you get the good stuff early.
Nice, yeah.
I would say if you're past that, which I think you probably are, because it sounds like your budget and your finances will work in good order, etc. There's one on my bookshelf back here. It's called What Up on Wall Street by Peter Lynch.
Can you reach it? Can you? I want to see the cover. I'm a judge a book by its cover, girl.
Don't judge my Star Wars Lego on the back shelf. It's that one.
One Up on Wall Street. Okay. Because that, like, just how the guy's dressed, I'm just like.
Yeah, so this guy
in over my head, like I'm
already like, manager, right? Which is why I dressed like that back in the day. But the way he wrote the book is in accessible language. I was struck by just how like conversationally normal the language was.
Nice.
And his credentials are he made 29% a year for something like 11 years, which is like insane.
Oh my word.
Just the way it might have been 13, but certainly it's at least 11, just the way his fund multiplied doing 29% a year. If you put that in a compound interest calculator, compare that to 14.5%, half that, it's like orders of magnitude higher. It's just incredible. But yeah, he's got kind of, it doesn't get too technical. There's no like formulas or anything like that really, apart from the PEG ratio, which is pretty straightforward. It's very much speaking to someone and you can pick it up as someone that's new to stocks and shares, and you kind of probably get it. I've read it a couple of times. I'll probably read it again. I think I want to read it every year because there's so many good points in it.
It's a case of books like that, isn't it? I think that's why I always get overwhelmed by it. I'm like, there's so much in here.
Well, this is the challenging thing, I think, because I've read several books on this, and see, they've all got slightly different views on things. And if you try to do everything that they all said, you just get yourself in a muddle. So that's why I think you need to have your objective. Like, what am I trying to do? How much money have I got?
Yeah, I like that. So the objectives, obviously, the obvious one is make money. What would other people's what would you say the different objectives are?
So the investing objective, you need to have a time frame. So how long have you got? Ideally 5, if not 10 plus years, probably 10 plus.
Okay.
I'd go for personally. And then like, what is the money, or what's it for? Is it just to make money? Is it because you want to retire at 50 and then by the time it's 50 you want it to be X pounds because you can take 5% a year out without issues? Excuse me. Is it you need to make a certain percentage a year And that kind of comes from the amount of money you need at the time, right? It's a factor of those two, and then how much money you're going to put into it. So I think it needs to be very specified. Or is it like you want to protect your capital because you've earned a load of money, just like, I just want to protect that from loss and also against inflation? Or do you want an income? Those are sort of things, but it just needs to be really specific. And yes, you might change it later on, but you need to have some idea of what you're aiming for and by when. And that
definitely.
hopefully determine then how you go about doing that.
For me personally, I knew, like, obviously I was out of money for lockdown. I wanted to earn, like, I wanted to be up like £1,000. So I felt like, because I was on my laptop and trading 212 pretty much all day, every day for like a month, because I was just in my house for the whole of, obviously, April 2020. And I wanted to make £1,000. So I felt like I'd earned money that month.
Yeah.
And I did that. And I would now feel like that was my goal. So now I'm kind of a bit goalless, because I'm like, I just wanted to feel like I had earned a wage that month. I know that sounds really strange, but I guess that was my goal. But I didn't get, like, necessarily, that obviously hadn't always been a long-term goal, because lockdown came out of nowhere and has now gone. Have you got a goal you're happy to share?
Yeah, it's my portfolio challenge on the YouTube channel. So £1 million in the portfolio, ideally in 30 years. Is it 30? 33, I think. Yeah, 33 left now. 35 to start.
So in 33 years, you want £1 million in your portfolio?
Yeah.
Are you happy to share how much you've currently got in there?
Yeah. As of last video, let me have a check, because I share the amount on the videos. So I'll just open that up. I think it's around about 38 in there.
Okay, 38,000.
Loading up the spreadsheets, yeah.
Nice.
So obviously quite a long way to go.
And how much did you put in to start off with? How much have you put in, basically?
So my minimum amount is £300 a month.
Okay, so you put £300 in a month.
Yeah. When I started the challenge about 2 years ago, I had about a 20,000 portfolio. So I sort of used that as the basis. It wasn't quite starting from no positions.
Yeah.
Probably would have done it slightly differently, but it started with some legacy positions at 20,000, £300 a month then. And then with my kind of budgeting, I say if I underspend over the course of a 12-month period on certain things, like during lockdown, it's fuel, for example, big spend on that, and general spending, because you're not eating out as much and all that sort of stuff. I try and put 80% of any underspending in a 12-month period.
Blimey, you were so structured on it. I love how different we are.
Well, that's
like,
cool.
Also similar. We're both careful. Yeah. Sorry. Yeah. Talking over you. But yeah, I love how we're both careful, but do it so differently.
I think that's the thing, is there's so many different ways to do it. There's no one correct way. I'm not an overly sort of creative person per se, so therefore my brain's quite logical and numbers driven. So that's hence the sort of more structured approach. But actually, ideally, you have the two in tandem, right? If you've got, this is why I like having these sorts of conversations, because you'll have some ways of doing things that I wouldn't even think of, because my brain just doesn't work in that way.
Yeah, and likewise.
Vice versa. Yeah. If you put the two together, you get like a super portfolio.
We're like a superhuman.
Yeah.
Perfect.
So, right, just to sort of finish off the last 5 minutes, I had a question written down for you. What's in your portfolio?
Oh my God, my portfolio at the moment is terrible. So I'm normally an unpanicker. Like, I don't really panic. But it was like a month ago. What happened? Something happened. Probably Boris affected something. So I sold every share that was in profit. So I now have no shares in profit. So my portfolio looks superb. So I have ASOS, Aston Martin. I don't even know how to say this cannabis company. Aurora.
Not come across.
BASF. Boohoo. Still got my £2 in there. EasyJet. IAGSA. Meta Platforms. I'm really surprised that they're down. I thought they would just go up, but obviously, if there was a share that only went up, it wouldn't be.
What goes up must come down, they say, right?
Yeah. Restaurant Group, Rolls-Royce, Superdry, Ted Baker, Tesco's, Tilray. Tilray are the company that I got so high on, and now we're on like minus 46%.
Ouch.
Travis Perkins, TUI, and Uber. Pretty much all of them, the ones that are left, like in here, are ones I bought in March 2020. And they have gone up. Like, because everything was looking all right, like last August, was it? Everything looked good, so I didn't sell it. And now they've all gone back down again.
Yeah, well, you're not alone in that. So you've got market crash. Now, the UK market's gone down a bit. The bigger companies, not by much. The smaller companies gone down by quite a bit more, maybe like a quarter. And the US market's gone down sort of 20% from peaks. But so that's the average. Some go down more or less depending on whether the Russia situations impacted them, energy prices, then higher interest rates, inflation, potential recession. And then there's just quite a lot of retail type ones in yours, like the airlines, ASOS, Boohoo, etc.
Yeah.
So these are the guys that high fuel prices are going to kill the airlines, right? And then at least in the short term, and then with retail, it's hard to say, but overall it'll go down. But will people move from expensive to online cheaper, which could benefit you, or will they just stop spending at all, which won't benefit you? But these are sort of short to medium term things. I guess what will happen after that, we don't know because it's a long term game. No. But it's interesting. You sold the ones in profit, so you locked in profit.
So I have like free funds in my account is 3,177.66, and I put in, I think I've put in like 2,700. So I'm up, and then in the portfolio is £920. That's like, so it's like £4,098.16 that's in all of it. But obviously, a grand of that is still invested in shares. So a grand might disappear, basically, is how I view it. But it's over so many companies that I'm just hoping that it doesn't. But yeah, so obviously my portfolio.
That's the thing. So you've got lots of retail and airlines. So
yeah,
it's over companies, but if they're all in similar sectors as more of a clumping, then that's not as diversified as you might expect.
No. And obviously that's why they're all left together.
Yeah.
Because I sold all the ones in profit, and it's like the whole sectors that are not in profit. But hopefully they won't all die and dissolve. Hopefully that they will, because like with me, I'm happy to leave them in there as long as they need to be in there. Like it's not like I don't need to sell in like a month or something, which obviously puts me in a better position. My boyfriend Richard also invested at the same time as I did in 2020, but his was to get a mortgage, so he has to sell his.
Okay.
Or has to sell his because he had put it in there to get more money to then have more money for a mortgage, or not a mortgage, a deposit.
Yeah.
So he obviously had a timeline on his, whereas I didn't have a timeline on mine. And I think that obviously affects a lot.
Yeah. I suppose the last question then would be, so you've got this cash position there. When would you deploy that cash? What's your view on that?
What do you mean by deploy? Sorry.
Buy other positions.
So whenever. It doesn't, like, I'd happily spend that this afternoon. But I think what I've learned over the last 2 years is that I need to like think about it more if I'm going to put in, because I would want to now put in bigger amounts of money, because £2 was great here and there. But that was just for whilst I started, because I wanted to make sure I understood it before I put in big amounts. And now I feel like I understand it a bit better. I'd want to put in more money into each company. So I need to make sure I've got the time. At the moment, there is no time. The business is mental. So I want to make sure like my headspace is like in it for when I put more money in, because I don't really have the time now to be like dabbling with £5 here and there.
Yeah, you're in it to win now. You've had your
yeah,
as it were.
I've played, I've worked it all out. Well, not all of it. No one can ever say they've worked it out. But I've got my head around how it works anyway. So I'm hoping at the end of the wedding season, I'll be able to have like more headspace to like put my mind into it. But yeah, it's not that I'm afraid of spending it. It's just I now want to spend it in companies that I have looked into.
And there's never a rush to buy stocks. It's one of the Peter Lynch and Warren Buffett things. Like, people are always in a rush to buy, and I've done that myself. But there's no rush. You can let opportunities go past. You only just need to, when you're ready to act if the opportunity is right. And if you miss some, you miss some. It doesn't matter. But if you've missed some, you haven't bought, you haven't lost money, right? You've still got money. So. Yeah,
definitely. That's a very good point. Yeah, because I often feel like I'm not, like I'm missing loads of months off. And I also feel like you're missing opportunities because the world is in such a rubbish place. There's good opportunities there to buy whilst things are low. And it's like, will those opportunities still be there? And the truth is, there's always going to be rubbish times in the economy. There's always going to be prime ministers leaving and coming and different things happening. I think I get really interested in it around Christmas, just to see. It's really interesting how everyone suddenly thinks the economy's fine. And then after Christmas, and like, then everyone's like, oh, hang on, no, everyone was spending money they don't have. Like, it all seems to change a lot around each holiday season. But yeah, I'm looking forward to getting my head more in it.
Cool. Excellent. It's probably good to wrap up there, because you've broken the rules. You mentioned Christmas in July, so I think that's time to end the podcast now.
It's the photographer in me. I always have to be thinking of what's happening in a few months, because people book up so early.
Like, what I will say is, on emilyfleur.com, there's a sale on Dartmoor prints when I checked. So if you like pictures of like Dartmoor and animals and stuff, I haven't described that very well, but check it out. They're pretty good. I've got some postcards.
They're all right.
They're very nice.
Thank you
for joining me on this one. Very good.
No, I've loved being part of it. Being the first one. Let's see who else you get on.
I've got at least 3 more lined up. So see.
I'm looking forward to listening to them. I'm sure they'll be more enlightening than me rambling.
You weren't rambling. It was very enlightening.
Perfect. Thank you so much for having me on.
Thanks a lot, and thanks to all the viewers and listeners as well. Have a good day.
Thank you. Bye.